The economy is wobbling, elections are looming, while the coronavirus and the market are both up. We'll cover that and more on today's quarterly context webinar. Welcome to the Advisory Group's quarterly context webinar for the third quarter of 2020 for clients and friends of the Advisory Group. I'm Greg Patterson, CEO. For those of you not familiar with the Advisory Group, we are a wealth and life strategy firm focused on helping business owners and leaders with their financial goals in their personal family realm, their fiduciary employee support efforts, and their communities through their foundations and endowments. To complement the strategic work we do with goal work we do with clients, our quarterly context webinars are designed to provide an approachable technical side, high-level perspective regarding the economy, markets, and investor behavior patterns in order to help both our personal wealth and institutional clients make better decisions and achieve their goals. We'll have an overview section and then a second section with additional charts and details for those who are interested in seeing more. And we try to keep these webinars to under 30 minutes, and we'll also circulate a link afterwards should you like to view some part of it again or to pass it on to someone you think we can help like we've helped you. And if you have any questions, please submit them to the question box and we'll most likely address those towards the end. So to get started, we always like to take a step back and provide the reminder to focus on your goals and what matters most, whether economies and markets are bumpy or if there are hiccups along the way with any goals or plans. The idea of focusing on that in that space between where things matter and things you can control. You know it matters, and the things you cannot control are markets, elections. I can have some influence on that, but not any single person. And so that sometimes can help increase peace of mind by focusing on that particular space. In terms of headlines, there were quite a few, as always, and that can cause some bumps in the market. Interesting to see the steep drop of the initial coronavirus market, the subsequent rapid rise, and the continued rise during the third quarter. And to put that into broader perspective here, you can see how even those big dips start to look small when we take a farther step back. Markets more specifically, very strong for the quarter overall, up in the 10% range for the U.S. stock market and emerging markets, about half that for international developed stocks and less for real estate, but positive as well on the bond side, both in the U.S. and globally. For the year, that shows 15% for the U.S. stock market and something closer to 5% year to date through the end of the third quarter at the end of September. Overall, U.S. stocks were up almost 50% from their low, the coronavirus low, which was fairly brief and one of the briefest bear markets ever, if not, I think it was the shortest bear market ever. And there was a big dispersion or range of returns across sectors. For example, consumer discretionary was up 15%, energy was down 20%. And year to date, there, one example of tech was up about 30% and energy down almost 50%. So all over the place in this unusual economy. And the market had a strong and broad rally for most of the quarter, or through at least the beginning of September. September was a little bumpier and negative actually in the month across a number of stock markets as uncertainty increases. There was a tech sell-off, but also had a subsequent partial rebound. Apple hit the $2 trillion market capitalization mark, which is a new record. I mean, that's just absolutely enormous in terms of company size. And there was an IPO called Snowflake that had a pretty high outcome initially, at least, and that's raised some concerns about how frothy the market might be right now. And PEs, price earning ratios, as a measure of valuation, are back up in the upper range with the last 2 quarters of strong returns. So all of that while there's still quite a bit going on in terms of the economy, in terms of Wall Street versus Main Street, and we'll see a few more of those things as we go along. We'll also just mention that gold is contradicting, usually goes up when the market goes down, but it's been going up near its all-time high, even though the stock market up. So there's this pushing forward of the stock market, but at the same time an increase in uncertainty, and that's oftentimes reflected in a higher gold price. We take a look at this 4 bad bears market, where we've combined the global financial crisis and the coronavirus market into that one blue line still. We can see the big dip here on this inflation-adjusted upper chart, and then the subsequent shot back up with a little bit of cooling more recently. The coronavirus itself, cases have begun to rise again globally and in the U.S. There are a number of states like California where it has come down and stayed relatively low. And in the lower left here, you can see the heat map recently of where the hot spots are, where things are heating up versus cooling down. All of this is really still in advance of the flu season, which normally peaks in February and really starts to ramp up in December. So we're not far from that, and there are big questions about that and how that might impact sickness in combination with coronavirus. However, in South America and other regions in the southern hemisphere, there's been a relatively low flu incidence this current last winter that they're coming out of, partly because of more distancing because of COVID and greater hand washing and so forth. So if we're lucky, maybe that will happen in the northern hemisphere as well, although the higher rates in general of COVID cases are in the northern hemisphere, so can't expect it to look too much like the southern hemisphere necessarily. There was also the first published case just this month in October of reinfection, which raises doubts about the ability to become immune. And the vaccine questions and dates keep getting pushed out. So a number of questions there about how long this will last, and may continue to go on for quite some time. And that will also affect markets and the economy to the degree that it does. So how long will this recession last? Of course, no one knows exactly. Some of the Fed numbers suggest that the bottom, that we're, of course, in recession now, but that it may have already bottomed out and may be picking up. The question is, how long will that stretch out? And that comes back to what we just talked about, in part, is coronavirus, flu, and then, as we'll talk about, and as you've seen in the news, the job numbers where unemployment is remaining fairly stubbornly high, even though it's improved a little bit off its big highs deep in the coronavirus pattern. There's some projections by a firm called ITR Economics, of a forward-looking basis, and they have a reasonably good track record of their forecasts. And they are suggesting that there'll be a slowdown, but not a deep recession through mid-2021, and that a more complete recovery where things are really kind of back to where a more normal type of state in terms of GDP and activity might be something more like the first part of 2023. So that's still a little ways out. But those projections, as is the case with other economists, are heavily dependent on the idea that there are a waning of coronavirus cases and no significant shutdowns of economies, either at the state or national level. And there are already some talk and some maybe not full shutdowns, but some tightening of restrictions in certain areas within the U.S. already at this stage, given some of the case increases. But if it were to really take better shape by 2023 or even 2024, that would still be materially better than the Great Recession's 7-year-long pattern that ended about 10 years ago or so. The GDP that's expected for 2020 is about -8% and about +5% for 2021. That's somewhere in the range of what the Fed and others are expecting, and that's on an annualized basis. The yield curve has not changed materially. You can see the 930 numbers look very similar to the 630 numbers. And the yield curve is essentially the bond market making a statement about its view of the economy. And when it's inverted, as it was back a year ago in this number, you can see 930.19, that usually precedes a recession, although the recession happened for a non-normal reason, COVID, which was not a predictable element. However, we were late in the economic cycle, so wouldn't be abnormal for some kind of pullback. But what's interesting now is that normally when the recession pattern hits its bottom and starts to come more towards the growth pattern, the yield curve would normally steepen more than it is now. And so that's an indication that the markets believe that there's lower growth on the horizon than would be normal for a market, or rather economic downturn. So as we said before, we'll say again, don't take your seatbelts off quite yet. Still quite a bit of uncertainty out there. So I'm just going to run through a few details here. And the final number for Q2 was down 33% for GDP, which was the worst in over 70 years. And the interesting low, coming off that type of bottom, the Q3 projection is up about 24% because if you have a 6% absolute return annualized, that's closer to 24%. So that's not surprising, nothing to get necessarily that excited about, because it's still coming off such a steep low of the second quarter drop. And again, some of the big questions that loom that might affect those numbers are COVID, elections, the stalled stimulus in Congress, and some of that uncertainty is also being reflected in the unemployment numbers, with initial jobless claims still at around 800,000 a week, but actually went up just this last week to 900,000, which was a bit of a negative surprise for the market, and has contributed to some of the volatility and market wobbling we've been seeing in the last several weeks. The continuing claims tend to hover still around 12 million, which is considerably above the 2 million average before the corona period. And overall unemployment peaked at around 15%, it was at about just a little bit above 8% in August. And of the 22 million jobs that were lost, only about half of them have been added back. Some of the policy elements that made some news is that the projection is that the Fed won't be raising rates until 2023 or 2024. So that further prolongs a very low, highly stimulative, cheap money environment, which is really part of what's been fueling the stock market. The Fed rates really have a big impact on markets, actually, more than politics, as we'll talk about a little bit later. The Fed also changed its policy approach, which was unusual, but changed the longstanding focus of a combination of employment and inflation to really a primary focus on employment, stating that they'll let inflation rise above the 2% target with the idea that they would do that until the for a number of years, the average ends up being around the old target of 2%, so that it averages out to 2%. So that's an interesting move, but does increase the chance of a rise, overheating of an economy, and that can increase the chance of a steeper pullback in the economy and markets down the road. So we'll see where that goes. The Fed also continues to restrain banks to conserve capital, and as mentioned before, that the stimulus is still stuck in Congress, and that has been contributing to volatility as well. GDP has been a wild ride. We placed these two charts physically on this page this way on purpose because we're trying to roughly line up where 0% would have been on this first chart. The second quarter is on the left, lower left here, where the projected numbers were way down and the actual numbers were very low. But now coming off that bottom with the numbers I mentioned as 24% annualized for the fourth quarter, all of a sudden the projections now, if you look at the scale here, negative and then positive here, this roughly lines up. You can see that the consensus as well as the Fed estimates have been ratcheting up in terms of what the potential GDP rate. Again, these are annualized numbers, so in the 20 to 30, mid 30% range. Again, that's roughly 4 times the absolute number for the projection for the quarter, but shouldn't get too excited about that again because we're coming off this steep bottom. So let's talk more about elections. We showed a chart like this in quarterly context about 4 years ago when similar concerns, which are common to arise in advance of elections in general, given the uncertainty and nervousness and how much they impact markets. And what you can see here is that in the long run, markets are relatively ambivalent to party. And as a result, trying to predict what will happen either in the election or in more specifically market reactions to the election can be kind of a futile game, and those that overreact with concern can end up paying a price because the market tends to chug along with bumps along the way. But the bigger factor tends to be Fed policy, where rates are, where rates go, and where rates stay, more than political party and the specific elections. Elections also seem to have relatively little impact on volatility just before and after the market. So these 13.8% numbers are not returns, those are volatility numbers, and identical before and after the election on average, going back quite a number of years back into the 60s. Similarly, if we look at actual returns now instead of volatility for a few different slices here, U.S. stock performance across all years, going back about 50 years, is about 10% on average. The presidential election years were a little higher than that. Midterm elections seem to be tougher on average on markets, and non-election years tend to be a little better. So in other words, the election years tend to be a little lower in general, but nothing really particularly specific to party. Below here on the left, we can see that this is stocks in orange and bonds in yellow, and that the presidential election years tends to be a bit of an advantage in terms of returns for stocks when the incumbent wins and for bonds when a new president is elected. So generally, that's not specific to party, but just reflective of the uncertainty about what policies will actually be with the new party, and then that tends to smooth itself out over time. And then here on the right, interesting to see that there's, to the extent that this is a really reliable pattern, hard to say, but tends to be that the third year in any given presidential term tends to be the strongest. So some fun numbers around elections there. Of course, there's nothing here really you can act on or that we would suggest you act on. This is just information to help you see that there's no clear pattern about what happens in elections with regards to markets. If we take a peek at the asset class corner, there are some clear patterns over time, but hard to know when that will happen. And what's illustrated here is the difference between growth stocks and value stocks. So there tend to be patterns where one will have a strong run and then pull off. So for example, this is growth strength and then growth periods of weakness and then growth periods of strength, usually followed by growth periods of weakness. And growth has been on quite a strong positive trend relative to value, especially on a relative basis, even though absolute basis returns over the last number of years have been quite strong for value as well. And a lot of this is dominated by what we call the FAANM stocks, which are a lot of the big tech stocks, and we'll talk more about that in a second. So this chart on the left is large cap, similar pattern on the right for small cap. So if you are excited about the growth part of your portfolio, or sometimes we see in 401k plans where people are return chasing and tend to load up on the growth funds and ignore the value funds, oftentimes at their peril in the long run, because that's tantamount to chasing returns and reduces diversification. And then when the tables turn, you get hit harder, and instead of getting rewarded by the eventual value uptrend. Taking a look again at the FAANG stocks, Facebook, Amazon, Alphabet, Apple, Netflix, and Microsoft. Sometimes people use one of those A's as a G for Google instead of Alphabet. So you're hearing of FAANM or FAANG, the sort of the two of the same thing. And what's interesting here is if you look at the market capitalization of those FAANG stocks, the total market capitalization of those stocks exceeds the entire developed Pacific region. And it almost exceeds the combination of Latin America, a big chunk of emerging markets, Asia, ex-China, and China. And it certainly, you mix any of those three together, it certainly beats those, but it's pretty similar in terms of overall size. 5 or 6 companies, 6 companies to be specific, that are that big. So just very unusual. You can see in the upper right here how the weighting of those 5 or 6 stocks in the index has grown dramatically just in the last couple of years. So that is highly unusual. And the return impact or contribution to the index has also grown. So there's quite a few stocks out there that have had pretty flat and some negative returns, while a lot of the big tech stocks have really driven the overall return of the markets and the indexes. Asset class corner part 3 is about something a little different, but also about diversification. This shows the valuations using a different metric than we might normally use, but ranks countries by its valuation relative to its historic median. So the U.S. ranks 5th in this grouping, and a bunch of other countries are undervalued relative to their average. So generally, that would suggest that there are more opportunities for a reversion to the mean and a boost in price value from the rest of the world relative to the countries that are already relatively overvalued. So that's just an argument to stay disciplined with international diversification, because it should reward investors over time. In terms of our blog, recently we have a few articles that might be helpful, including how tax policy might change depending on the outcome of the election. A presentation or summary of 7 lessons from Ironman triathlons that I wrote and recently did a presentation on at a conference that I hope you might find interesting, that we hope, and a number of other topics that you should find valuable and interesting. So take a peek at our blog and share those articles with people you know. In terms of the rules and regulations corner, not a lot to cover today. I won't go into depth into these retirement plan elements here. feel free to reach out to us if you'd like to discuss any of these in more detail. No significant updates on the personal wealth general side, and continuing to approach a launch date for WellStep with our development team. There was a little bit of a slowdown there during the COVID period, and now that's speed is ramping back up with that. So that's a tool designed to help 401k plan participants and also smaller investors, which might include the adult kids of our personal wealth clients. One other announcement for the day. There's a few of you that haven't quite received notification, but most have. But both personal wealth and institutional clients will be getting access to updated and better tools through our website, through our web portal, in terms of forms and documents and reports and so forth. So we're excited about that, and our internal group that worked on that did a great job, and I think you'll find this helpful. Also provides a secure way to transfer documents rather than sending them by email if they contain sensitive information. So this should be a helpful tool, and we look forward to hearing your feedback about it. You can also access it through apps on your tablet or your phone as well. So while you're on the go, you can check in on some key numbers and information if you find that helpful. So that's the first part of our quarterly context for the day. We'll run through a few other charts here briefly, but I want to thank you for joining this first section. And always please provide feedback to us of some sort about this quarterly context presentation or other ways we think you can be helpful. And encourage you to share the word about the advisory group with those that you know, whether they're institutional or personal, family, potential clients or people that we can help like we've helped you. So let's get into a few additional charts. And that starts with a business cycle chart. So where we are right now is somewhere on this recession side, but this just highlights what companies tend to, what each stage is and what types of companies tend to do well in different segments of those market stages. Volatility has, after its big spike, has come down a bit and now is kind of wobbling around this range more recently. In terms of some of those economic metrics we hit on before, unemployment has come down, but is hovering at still a higher than normal level. Inflation remains fairly low, but as mentioned with that change in monetary policy, that could be finally what causes inflation to pick up a little bit down the line. Consumer sentiment hit a low that we hadn't seen since about a decade ago, and then has improved a little bit. At least in the short run. That could be interesting to watch as we go into the flu season if COVID picks up and if unemployment numbers start to trail off again a little bit more. The price of oil has been volatile and also bouncing around in its kind of historical, relatively low range. And the dollar has weakened a little bit in this recent time period. In terms of consumer, corporate, and national debt, the numbers are pretty big. If you look at non-financial corporate debt, the numbers have spiked up as companies have taken advantage of low rates, and default rates have also gone up to some degree. That's been challenging for some high-yield bond managers where better or investment-grade bonds have dipped down into high yield and then gotten a boost by changing into an index. So there's some unusual dynamics there that for those types of managers. The good news on this chart is the household debt service ratio has come down. So family balance sheets are a little bit stronger. So that's good. And that was helped by the stimulus packages. And household net worth has improved a bit as the market has risen and as those debt service ratios have come down. All of that could change as if the market wobbling increases, or if stimulus stops and joblessness increases or stays the same for a longer than expected period of time. Federal net debt is at pretty high levels, really back to post-war levels. And by that, we don't mean recent wars. So some would say that there's a piper to pay sometime in the next 10 to 15 years, and we'll have to see how that plays out. In terms of high quality versus lower quality stocks, higher quality recently has been in the middle of the pack during this unusual period, but trailing some of the higher momentum stocks that you can see in purple that tend to do better in more speculative periods like we're seeing now. Mutual fund cash flows sometimes tell us about the behavior of the average investor. We can see, if you look at the past here, cash numbers have been relatively low, but have ballooned year to date. These are numbers in billions. So, that's a big chunk of cash there. Some money has come out of multi-asset funds, which may be primarily target date and other funds in 401ks. Money's been flowing out of U.S. equity markets and the world market and into bonds and cash. So that's interesting because bonds are really not a great place to hide. In many ways are certainly less risky than stocks, but riskier on a relative basis than they have been historically, given the rates are so low. And when rates eventually go back up, that can lead to some volatility for bonds. But again, that won't compare to typical volatility in stocks. We talked a little bit about valuations before, but here are a few charts. You can see the PE ratio and its pattern over time has picked back up after a pretty steep drop, but back up into pretty high territory now. Oftentimes that precedes some sort of cooling. And similarly, whereas the numbers a quarter or two ago were hovering back around the medians, large cap growth stocks are back into their maybe upper decile again. So that's, and a lot of the numbers across different stock markets here are in the upper range that oftentimes precedes higher volatility and some market cooling. But that certainly can't be predicted because we don't have a crystal ball. We can predict volatility will eventually increase, but it's, of course, very difficult to say when. Also, as a reminder, this is a high-level view of the 5-step investment process. There's also a 5-step personal wealth planning process, and for clients that are in the foundation endowment space, a spending policy process. But the basic idea, as a reminder here, is that there's analyze, design, formalize, implement, and monitor. And so the decisions that the advisory group helps you make as clients and those that we process internally are driven by a process-based approach. So very careful, thoughtful, methodical, research-based, process-based approach, which helps improve outcomes and improve consistency over time. And for fiduciaries, is essentially an insurance policy of sorts, because the Department of Labor can't hold retirement plans accountable to market results, but they can hold you accountable to whether or not you followed a prudent process. So if you're following a prudent process, then you're generally in good shape. Another reminder slide here. Won't go into a lot of details here, but follow up with us if you'd like to discuss. This is a compilation of investor behavior studies. Usually in the first part of this presentation, we highlight something around investor behavior in general, but these are related to fiduciary behavior patterns that in the end, in some ways, are not that different on average than the average investor, individual investor. Of course, our clients tend not to exhibit these problems given the process and guidance. But for example, is one pattern of when a manager is underperforming and then is replaced. Oftentimes it's the replacement manager that does worse, because there is a pattern out there in general of people, fiduciaries and others, looking at the recent hot performance of another manager and believing that will persist, and letting go of a manager who might be at a cyclical low, who's about to return into favor, and instead losing patience with that manager. And there are times to replace a manager for performance, but if the process, people, philosophy, and so forth are in place, oftentimes it makes sense not to replace a manager low, so that you make sure that you recover that other side of the cycle and benefit from the strength they have in the cycle that follows. So I want to thank you for your time today. Appreciate you joining us, and we'll pause here in a moment to see if any questions come into the question box. So thank you very much. Stay healthy, and please reach out about any questions if you don't ask them today. We look forward to hearing from you.